paying off a mortgage may not always be the most financially savvy move. Instead, investing the money into other assets that may have a potential to generate higher returns could be more beneficial. You ask, higher returns compared to what? Compared to the interest rate you're paying.
Are you ready to transform your life? This is a no-nonsense show helping immigrants like you create generational wealth, even while working full-time. Get ready to take notes. Here's your host, Saket Jain.
Welcome back, my Great to Wealth listeners. I hope you're doing well. Today's topic is something that can keep a homeowner up at night, staring at ceiling and questioning life choices. Should I pay off my mortgage? I mean, we all have that friend who tells us how they own their home outright. They're living their best life debt-free. But let's also be real. There are the ones who are always complaining how they don't feel like they have enough money to pass for their retirement. So is it really worth to follow in their footsteps and pay off our mortgage? Or should we just accept our debt and move on, right? Well, in today's show, we'll be diving into the pros and cons of paying off a mortgage. We'll talk about how interest rates play a role, and we'll also get into some tax considerations. I know. Some of you might be thinking, but wait, I don't even know what a mortgage is. And that's A-okay, right? We'll be covering the basics. You know it by now, if you've been listening to this show. So grab a calculator, a glass of wine, or your favorite beverage, and join me on this wild ride of mortgages and numbers. Just kidding. It's not that bad. You know me by now. I really like to keep things simple, right? And K through 12, everything. But before we proceed, I do have a disclaimer. As always, consult your financial advisor before making any big decision. Paying a mortgage qualifies to be that decision. Right? But along the way, also don't forget to have some fun and enjoy the journey because you deserve it. You worked hard towards it. Now let's talk about what is a mortgage and how does it work. A mortgage is basically a loan that you take out to buy a house. You work with a bank, they give you the money to buy the house, and you pay it back over time. It's usually about 15 or 30 years. But before the bank gives you the money, they'll want to make sure that you can afford it. So they look at your income, your savings, they look at your credit scores. And so essentially the house that you're buying is really a security deposit for the bank. And the bank holds on to the title of the house until you pay off the loan. Broadly speaking, there are two different types of mortgages to choose from. Each of them have their own benefits and drawbacks, right? Like anything else. It's fixed rate and adjustable rate. The first one that we'll look at is a fixed rate mortgage. The interest rate in this type of mortgage stays the same for the entire loan term, 15, 30, or whatever the term is. That means the monthly payments will stay the same no matter what happens in the market. And you know exactly how much you'll be paying each month. This type of mortgage is great for people who want stability and predictability in their monthly payments. The second type is an ARM. It's called adjustable rate mortgage, where the interest rate can change during the loan terms. This type of mortgages tend to have lower interest rates upfront, but the payments may increase as the interest rate goes up, if the interest rate goes up. This can be risky for some, because if the rates increase, then your monthly payments will also increase. So it gets tricky to put a budget together and plan for your finances. Now, since we live in an inflationary time, I believe it's important to point out that as the value of money decreases due to inflation, the purchasing power of the money is also reduced. A fixed rate mortgage protects us against this because the payments remain the same. However, the value of the loan is decreasing as the time passes, which means the borrower is paying off the loan with dollars that are worth less and less. This means that in an inflationary period, borrowers with fixed rate mortgage end up paying off the same amount of money in principal, but that money is worth less and less due to the inflation. So what really are you doing is you're locking it's an inflation hedge. Now, one of the biggest benefit of paying off the mortgage is being debt-free. It eliminates the need to make regular mortgage payment, and it can free up some money for other expenses or investments. It can also increase a sense of security and peace of mind, knowing that you own the home outright and you have now one less debt to worry about. Another benefit is building equity in the home. With each mortgage payment, you're paying down the principal balance and increasing the amount of equity you have in the home. This can be beneficial if you ever have to borrow using a home equity line of credit or home equity loan. And it's getting harder and harder in the times we live in, but it's definitely possible. In addition to it, there are psychological benefits involved with it. It could give you a sense of accomplishment and pride, especially if you've been working hard to pay off the mortgage. It can bring a sense of stability, security, that you can live in your home as long as you wish without having to worry about rent increases, or landlord decisions, right? And there are other benefits as well, but let's switch to the downsides of paying the mortgage. The first one being the opportunity cost, right? Paying off a mortgage may not always be the most financially savvy move. Instead, investing the money into other assets that may have a potential to generate higher returns could be more beneficial. You ask, higher returns compared to what? Compared to the interest rate you're paying. It can also reduce the liquidity because you're putting more amount of cash into the home, so it has an effect of what your liquid cash available to you is. It could be a problem if you wanted to use that money for investing or some other purposes, or to build emergencies, right? To build some cushion for unexpected expenses. There's also loss of tax benefits. In the US, you can deduct your mortgage interest on your taxes. So it can increase the overall tax bill for the borrower if the mortgage deductions have been a significant part of your tax return if you pay off your mortgage. There's also lack of financial flexibility. Once the mortgage is paid off, the homeowner has lesser financial flexibility because they can't necessarily tap into the equity for renovation, to purchase an investment property, or in case of emergency. They'll have to go to the bank to apply for HELOC or whatever. Interest rates play an important role in the decision whether you want to pay off the mortgage or not, as they can really affect the opportunity cost of paying off the mortgage. Let's talk about that. When the interest rates are low, the cost of borrowing the money is low, which means that it is relatively cheap to borrow money, whether it's through a mortgage or through a personal loan or what it may be. In this case, it may be more advantageous to invest the money rather than using it to pay off the mortgage. On the other hand, when the interest rates are very high, the cost of borrowing the money is relatively expensive. So it may be more beneficial, you have to evaluate that, to pay off the mortgage early in order to save on interest payments. Also, when the interest rates are low, the potential returns on other investments may be higher than the savings on the interest, right? Because their cost of borrowing the loan, the investment cost of borrowing loan, is also low. This represents the opportunity cost of paying the mortgage, as the money you use to pay off the mortgage could be invested in other assets that could generate higher returns. It's also called arbitrage. It's the emergency fund, right? Emergency fund is a savings account that is set aside. Let's talk about that, to account for medical emergency or job losses. It's generally recommended to have 3 to 6 months of living expenses. I always say in the times now, it's 6 to 12. Having this cushion provides you peace of mind to dip into during the time of crisis and not having to go into debt. It's really the first line of defense when the unexpected happens, just like an insurance policy. So it's important to strike a balance between both savings for an emergency fund and paying off your mortgage. I would recommend to have some money set aside for unexpected expenses before you start aggressively paying down your mortgage, should you choose that. We talked about tax considerations. Let's expand on that, right? In the US, mortgage interest is tax deductible, which means the homeowners can deduct the amount of interest they paid on their mortgage from their taxable income. It could result in lowering the tax bill, and also, which essentially means more money in your pocket. You can invest on other things. When you pay off the mortgage, you no longer have the ability to claim it because there's really no mortgage interest left, right? It could result in a higher tax bill. Now, this could be significant for homeowners who are in the higher tax bracket and have large mortgages, right? We're talking about millions of dollars in mortgage. You may say, all this is good, mumbo jumbo, Shakir, but what is really your opinion? You seem to be flip-flopping in pros and cons. Now, I'll tell you, since the show is all about migrating wealth, I created that with that intention. And I'm all about creating generational wealth while positioning yourself to be financially free I would invite you to really think hard about not paying your mortgage as we continue to move into an inflationary environment. I'm basically saying do not pay off your mortgage. As the value of money continues to decrease, if you lock in your payment in today's dollars, it may make sense to hold off from paying off your mortgage and use the surplus funds to generate higher return through investing in real assets. And you know by now, real assets tend to appreciate in inflationary environments, thereby multiplying your wealth faster than if you had paid off your mortgage. I do need to say something here about conventional thinking. If you depend on conventional thinking, people always would advise you to pay off your mortgage. But then you can choose to be conventional or you can choose to be wealthy. You can't do both, right? So do yourself a favor and think for yourself. Why don't we make it all real with an example? Let's say Sarah, our avatar, has a mortgage of $500,000 with a 3.5 interest rate. She got it several months ago. She also has $20,000 in surplus, which she's considering to pay off the mortgage. However, after researching, listening to Migrate to Wealth, and speaking with Saket, she decided to invest $20,000 in an oil and gas limited partnership. This enabled her to invest in the exploration, development, and production of oil and natural gas through a partnership, passive interest. The investment is expected to return about 10% annual return, and over the long term, but with the potential of capital appreciation. The expected return on this is definitely greater than the interest rate on our mortgage. And she prefers to, when she evaluated the risk and reward profile, she went into the gas investment. Now, if Sarah invests $20,000 at 10% annual return for 15 years, the investment will compound to approximately $240,000, which is 12x her initial investment. 1,100%, 1,100% growth in the money. It far outpaces the savings that she would have had by paying off the mortgage. Now, I know I'm using this example to make a point, but returns may vary. There's always risk profile involved, and you have to evaluate that for your point, but hopefully you get the point. In conclusion, whether or not to pay off a mortgage early is really a personal decision, no matter what I say. It depends on your individual financial situation, your goals, your life, everything, right? While paying off a mortgage early can save you some dollars, thousands of dollars maybe, in interest charges, it also has an opportunity cost that you need to consider before making a decision. So on that high note, that's all we have for today. If you, as always, if you have any questions on how to use real assets in multiplying your wealth and how to compare the savings and mortgage, schedule a complimentary call with me. I'll be happy to review your personal situation and help you develop a custom plan that meets your goal. The link you know where to find. It's included in the show notes below. Thanks for tuning in. I look forward to seeing you on the next episode. Cheers.
If you got value from this episode, you might consider sharing this content with a friend. But most importantly, be sure to take action on what you've learned. One way you can take the next step is to connect directly with Saket on an investor call. That link is waiting for you in the show notes below.
The content of this podcast is for informational purposes only. Please consult your own advisors when making any investment decisions. Keep listening. We'll see you on the next episode.